You're about to hear a number that sounds like the end of the world. $970 billion in commercial real estate debt is coming due in 2025. That's $1 trillion problem, right? Wrong. This video is going to show you guys why that number is mostly smoke and mirrors, why this isn't 2008 all over again, and why savvy investors are preparing, not panicking. We'll talk rent growth, valuation cushions, lender behavior, and the math behind the headlines. Because I bet once you see the full picture, you'll understand this isn't a collapse, it's a reshuffle. So let's break it all down and get into things. The big number trick. 970 billion sounds scary until you do the math. Everyone's talking about the $970 billion debt wall. They say it like it's never happened before, like it's a monster we've never faced. But guess what? In 2008, we dealt with 780 billion in maturities, which is an inflation-adjusted number, but that's pretty much the same thing. And since then, property values, rents, and incomes have all increased dramatically. Look, a 24% rise in debt maturities over 17 years is normal, not scary, certainly not historic, and definitely not catastrophic. Here's what changed. Fear got louder with the internet. Media got better at panic headlines. But the math, it's almost identical. Don't fall for their fear porn. Fall back on the fundamentals. This ain't 2008. Today's fundamentals are stronger than ever. In 2008, loans were toxic. 2008 had things like no doc, low doc, fog of mirror. Borrowers had no equity. Lenders absolutely didn't care. Today, loans are based on actual income. Borrowers have real skin in the game. Underwriting is strict. Let's add something critical here. In 2009, apartment rents dropped over 6%. Vacancy surged and net operating income literally got crushed. But in 2021, rents skyrocketed 12+% for new leases and 8+% for renewals. Some cities saw 20 to 25% jumps in under 2 years. From 2020 to 2022, median multifamily rents rose over 25%. That's not a soft bump, that's a rocket launch. And unlike 2008, income didn't collapse, it exploded. 2008 was built on lies. 2025 is built on income. Look, in 2025, these aren't junk loans. They're low-rate loans in a high-rate world. Here's where people get confused. They think loans maturing in 2025 are leftovers from a past disaster. They're not. Most of these loans were made after 2019. They were funded during the low interest boom. They're clean, they're conservative. They were built on record high rents. The problem today isn't credit, it's timing. Rates jumped and refi math broke. It's not a crisis, it's just a bad calendar year. And smart owners, they're adjusting, not defaulting. Now listen, if you want my complete playbook on how to increase your net operating income without spending millions on renovations, I've got something for you. It's called the Multifamily Value Add Playbook. It breaks down simple, powerful ways to raise income, boost value, and outsmart the debt cycle. It's 100% free. Just head over to Instagram, find me at Paul Macaluso, hit follow, and DM me the word playbook. That's it. No opt-in, no funnel. I'll send you the direct link. Let's get back into it. Look, the zombie debt narrative is a myth. You'll hear people throw around terms like zombie loans and legacy debt. It sounds scary, but here's the truth. Less than 10% of the debt maturing in 2025 is more than 10 years old. If your loan was made before 2015, it's either already been refinanced or it's too small to move the needle any. Look, this isn't about old skeletons in the closet. This is about fresh loans facing new interest rate reality. We're not unwinding the past, we're recalibrating the recent. The fact of the matter is, it's a spreadsheet problem and not a market collapse. Let's get something straight. Most of these buildings are fine. Tenants are still paying their rents, and rents are still strong. But when your loan was based on a 3.5% interest rate, and now you're being quoted 7%, yeah, that math changes a little. it doesn't mean that the property failed. It means that your spreadsheet needs a second look. This isn't a vacancy issue. This isn't a rent collapse. In fact, rent growth during the pandemic gave most properties a serious cushion. And that cushion, it's actually what's helping owners survive this rate shock. The truth is, we've seen worse and we handled it with less. Let's go back to 2008 for a second. Rents were falling. Banks were failing. Loans had literally no equity or negative equity. The buyer pool basically dried up and disappeared, and the government was in panic mode. But guess what? We still made it out. Now, compare that to today. Rents are up, net operating income is actually strong, banks are better capitalized than they were then, and the overwhelming majority of loans actually still have a significant amount of equity. So, you have to ask yourself, why are we more scared now than we were then? The truth is because the noise is louder, but the numbers are better. You guys watching gotta remember that headlines sell fear, not facts. Let me say this loud and clear. $1 trillion in debt due is designed to get clicks, not to provide you guys any kind of clarity on what's going on. You're not being shown the full story. You're not being told how many of these loans will most likely be extended. You're also not being told how many of these loans will actually be restructured. You're not being told how many lenders are actually working with borrowers to avoid any kind of distress. And the reason for that is simple, because that's not a story that sells. The truth is boring, but boring is actually what pays. So what's really happening? Capital is getting repriced. This isn't a crash, it's a remix. Capital is moving, structures are shifting, and terms are evolving. And yes, some sponsors will get squeezed. Some equity will get diluted. But most of these deals, they'll survive. This isn't a cliff, it's a chessboard. And the best players are just making smarter moves. All right, guys, let's wrap this up. $970 billion in maturities isn't new. It's just louder. Most of the loans maturing are recent, not rotten. Unlike 2008, we have strong rents, solid incomes, and better borrowers. Valuations may adjust, but this isn't a collapse. And the fear, it's engineered. In 2009, rents dropped and froze. In 2021, they exploded. That's the difference, and that's why I'm not panicking. I'm preparing. If you enjoyed what you watched today, don't forget, if you want my multifamily value add playbook, go find me on Instagram at Paul Macaluso, follow me, and then shoot me a DM with the word playbook. I'll send it to you directly with no BS. Let the other folks keep watching headlines. Let's build something real together. Thanks for watching, guys. If you found value in today's video, please make sure you subscribe to the channel and hit that notification bell. I try to drop at least 2 videos a week for you guys. And don't forget to leave your comments below and let me know what you think 2025 market is going to look like where you're at.